Welcome back to the deep dive. So if you've ever walked into a liquor store and just, looked at that perfectly lit wall of spirits, you probably noticed two things.
Mm-hmm.
First, the just sheer number of bottles, and second, the crazy differences in price.
Right.
It looks simple, but today we are going deep into the financial sources you shared to really pull back the curtain on this. We're going to deconstruct the industry's engine and find out where the real money is made.
And it's a fascinating story because most people, they just assume success means selling the most stuff, the most units.
But more is better.
Exactly.
Yeah.
But our source material, it shows this really powerful counterintuitive truth. The products that sell the most bottles, they are not always the ones making the most profit. So our mission today is to uncover the 5 big takeaways here.
Okay, let's just get right into it then, because the first major shock in the data is this fundamental split you mentioned between volume, the number of units sold, and value, which is the total cash generated.
You have to know which lever to pull.
And the data immediately exposes what you called the big lie of volume.
It does. We're not looking at one market. It's really 2 very different things happening at the same time. And the best way to see this is to put 2 giants head to head, wine and whiskey.
Okay, lay it on us. Where's the volume?
Oh, it's wine. It's not even close. Wine is the undisputed champion of sales volume. When you add up every single bottle sold, wine accounts for a massive 43.89% of all physical units.
Wow. So almost 1 out of every 2 bottles sold is a bottle of wine.
That's it. It's monumental market penetration.
So if wine is the workhorse, the engine just pushing out units, what does that mean for revenue?
And this is where it gets really interesting. Despite selling almost half the bottles, wine only brings in 23.14% of the market's total revenue.
Okay, hold on. So it's doing nearly half the work for less than a quarter of the pay.
That's a great way to put it. The implication is huge. Wine operates on these razor-thin margins. It's accessible, it moves fast, but it's a high-volume, low-margin game.
Which has to be driven by production costs, right? I mean, wine doesn't need to age for years like a spirit. It's a faster turnaround from harvest to bottle.
Exactly. The whole structure is built for speed and volume. But now let's look at whiskey, because it completely flips that script.
This is where the money is.
This is where the money is. Whiskey captures a huge 29.78% of the market's total value.
So more than wine.
Way more. But it does this from just 18.89% of the sales volume. They're selling far fewer bottles, but walking away with almost 1/3 of all the dollars in the market.
And that's all about the inputs, the expensive casks, the years of aging, the fancy packaging. It all lets them charge a premium.
And get much, much higher margins per bottle.
So you've got these 2 modes running in parallel. One is about mass market presence, getting on every shelf. That's wine. The other is about specialized high-value returns. That's spirits.
That's it. Which brings us perfectly to our next point.
Premiumization, the industry's favorite word right now. Convincing people to spend even more on those high-margin spirits.
Absolutely. It's the engine of profit growth. It's this whole trend where people are willing to pay a lot more for, quality, brand story, rarity, and experience.
So give us the best example of this. A niche taste that's just punching way above its weight class.
Tequila. Tequila is the perfect case study. It generates an impressive 10.39% of the entire market's value.
Okay, 10%. And the volume.
Only 5.49% of sales volume.
Wait, so it almost doubles its value share compared to its volume footprint? That's an incredible margin multiplier. Consumers are basically saying, yes, we will pay a huge markup for this brand.
And if you want to see that idea pushed to its absolute extreme, you have to look at single malt Scotch whiskey.
Even more extreme than tequila.
Oh, yeah. This one subcategory generates 10.34% of the market's value, so almost the same as all of tequila.
Okay.
From a tiny 2.92% of the total volume.
That's extraordinary. That tiny sliver of volume is bringing in the same revenue as the entire tequila category.
It really shows you where the highest rewards are. It's in catering to people who want that top-tier brand, the quality, the prestige. These things are almost status symbols.
But I have to ask, is that sustainable? I mean, is this a bubble? Tequila especially has had this explosive, almost faddish growth lately.
That's a critical question. And while hype definitely helps, the underlying shift seems pretty durable. I mean, single malt Scotch has spent decades building its reputation. Tequila has successfully rebranded itself from a party shot to a sipping spirit.
Right, which justifies the higher price tag.
Exactly. The high margin is now sort of built into the category's identity. It's the new normal.
Okay, so premiumization is the trend. What's the third takeaway?
It's about the exception. The one single product that performs so well, it actually skews the whole market. We call it the unicorn bottle.
So one SKU, one specific product that acts like a financial anchor for its entire category.
Precisely. Let's look at one specific bottle. Clases El Reposado Tequila, the 750 mLs.
Yeah.
This one bottle. It commands an astonishing 4.65% of the total market's value.
Get out of here. Nearly 5% of all the money in the entire market comes from that one single tequila bottle.
That's the power of a unicorn. And now guess the volume it's moving.
It's got to be tiny.
A minuscule 0.34% of sales volume. To get almost 5% of the value from less than 0.5% of the volume, that's the definition of a high-margin anchor.
It's optimized for pure profit. I mean, the packaging alone, that hand-painted bottle, is a huge part of its value.
Absolutely. The investment isn't in mass production. It's in branding and creating scarcity. Now, let's hold that number up against the biggest volume mover in the entire market.
The mass market engine.
Right, which is Four Cousins Natural Sweet Red Wine. That one wine drives 8.86% of total volume. It's everywhere.
Almost 9%. Okay, so what's its value?
Much smaller. It comes in at 3.22% of total market revenue.
So let me get this straight. The Four Cousins wine sells, what, 25 times more bottles than the Clase Azul tequila?
Roughly, yes.
But it makes less money overall.
It makes about 2/3 of the revenue. This just defines that dual market perfectly. You need both, but you can see which one pays the better dividend per unit.
Which leads us to the environment where that dividend gets multiplied. We've talked about what makes money. Now, where is it maximized?
Exactly. It's not just about the product. It's the sales channel. You might think the big liquor store is a profit hub because it sells so many bottles.
That's the assumption, yeah.
But the data says the most profitable room in town is a bar. We're talking about the on-premise market.
So bars, restaurants, places where you drink it right there.
Correct. And no channel generates more value per sale than that on-premise market.
Why is the markup so much higher there? There has to be more to it than just a simple price increase.
Oh, it's the whole experience. You're not just paying for the liquid.
Yeah.
You're paying for the service, the atmosphere, the mixologist, the fancy ice.
The story.
The story. It allows that brand value to just multiply. The data is clear. The bar and restaurant channel generates a massive 14.67% of total market revenue from just 5.77% of sales volume.
Wow, that is almost 3 times the revenue for the volume. That margin multiplication is staggering. So the bar isn't just a place to drink, it's a financial lever for these high-end brands.
It is. A brand like the Macallan's Single Malt Scotch, for example, generates a significant 3.04% of the total market value just through this channel alone. If you want to be a premium brand, you have to win in the bar. Period.
This has been a fascinating look at revenue drivers, but we saved the most shocking secret for last, didn't we?
We did.
Everything we've talked about, premium brands, volume, bar profits, it all comes down to one simple thing. The bottle actually has to be on the shelf for someone to buy it.
And this is where we shift from strategy to, well, to logistics. And it's our fifth and you could argue most critical takeaway. The industry's biggest threat isn't another company.
It's internal failure.
It's internal operational failure. Specifically, stockouts. Empty shelves where high-demand products should be are leaving guaranteed money on the table.
So it's just revenue leakage, like finding a gusher of oil, but you don't have enough trucks to haul it away. A consumer walks in, their favorite bottle isn't there, and they just switch to something else.
That's precisely it. You're not just losing a sale. You're handing market share directly to your competitor. And the scale of this problem is huge.
So who are the biggest victims here? Which brands are getting hit the hardest?
The analysis points to two giants, Jameson and Four Cousins. They're suffering the most from these consistent stockouts. And look at their combined footprint. Together, they account for 20.63% of the market's total volume.
A fifth. A fifth of the market's entire volume is subject to these availability gaps. That's a staggering figure. Why is this happening? You'd think demand would be predictable.
It often comes down to things like poor forecasting, bottlenecks in the supply chain, not enough buffer inventory. You have these incredibly popular items that need to flow perfectly. And when anything goes wrong, a shipping delay, a labor shortage, shelves go bare.
And for a brand like Four Cousins, which lives on volume, that's a disaster. For Jameson, it means someone who wanted to make a high-margin cocktail just uses a competitor's whiskey instead.
It's a direct loss.
I think anyone who's ever hosted a party knows that panic when you run out of the main drink. So the conclusion here is that the biggest opportunity for growth isn't a new marketing campaign. It's just making sure the popular stuff is actually in stock.
The biggest threat to profit is the empty shelf.
Wow.
That's the ultimate takeaway. The battle for the next point of growth isn't going to be won in a branding meeting. It's going to be won in the logistics warehouse.
So this whole deep dive, it's completely reframed the simple act of buying a bottle. We've seen this hidden tension between high-volume products like Four Cousins that build market share and these high-value anchors like Class Azul that drive pure profit.
Right. And it all depends on this overlooked foundation of logistics. The whole premium strategy just collapses if the supply chain fails.
And as consumers keep looking for those premium experiences, it seems like the biggest question isn't who will create the next hit brand.
Yeah.
It's who can actually keep it on the shelf. That internal challenge, just closing that stockout gap, that's where the next massive battle for profit will be won. Something for you to think about the next time you see an empty spot where your favorite brand should be.